Hello, welcome once again to today's section. Today we are going to look at overview of financial management. So financial management is also another branch of finance that deals with how firms manage or optimize their financing decisions and the various sources of finance that they can be combined to help maximize shareholders' worth. Right. So our objectives for today is to explain the role of financial managers in achieving the objective of wealth maximization. Two, to explain why profit maximization is defective as the goal of financial management. And three, explain the ultimate goal of financial management. So after today's section, you should be able to, know the ultimate goal of financial management, also the various objectives of wealth maximization. All right, so let's start. So decision areas in financial management. So we have various decision areas in financial management, and one of these areas are external financing or capital structure decision. So external financing. So it talks about how financial management is about the sources of funds, all right, to support the operation and capital expenditure requirements of a firm. So management try to generate funds from various sources. We have the internal sources and external sources. So each of these sources has advantages and disadvantages. So managers are encouraged to choose a combination that will increase the value of the firm. So it's the responsibility of the financial manager to determine the mix of equity and debt that will maximize the returns on or the investment at the minimized risk of external financing. So the one that will maximize the return and at the same time minimize the risk of what external financing. So another form or decision area is the capital budgeting or the investment decision. So capital budgeting talks about how firms commit their resources to long-term financial projects. So projects that involve substantial amount of cash flows. All right. Yeah. So for firms to pump in much money into capital projects, they must scrutinize the project to see if the project is worth performing. Right. So capital budgeting or investment decision talks about how firms commit funds to long-term investments or capital expenditure. So capital budgeting is important because, yes, as I said, it involves the commitment of large amounts of the firm's financial resources and also defines the ability of the firm to develop the capacity for a competitive edge into the future. All right. Dividend policy. Um, dividend policy talks about how firms decide on the profit that it has generated, whether it will pay the profit, all of it out as dividend, or it will pay some, or it will not pay at all. Do you get it? So financial managers, when they are taking dividend policy decisions, they should evaluate the value enhancing possibility. So they should weigh out all the possibilities involved. If they are paying out the firm's earning as dividend or they are returning it, what is the consequence? And what is the growth purposes, or what will happen if they are paying some as dividend and they are returning some, or they are plowing back some into the business. So these are some of the things that businesses and financial managers are to consider when making dividend policy decisions. Working capital management or short-term financial planning decisions. Yeah, so working capital management is kind of relating to short-term financial way. So the working capital management function requires managers to decide on which short-term operating cash flows to be managed. So which short-term operating cash flow to be managed, um whether the ability of the business to pay a short-term obligation as and when they fall due will also depend on the liquidity position of the organization. So working capital management decisions relate to how managers can vary the composition of current assets and current liabilities in order to match the cash inflows with cash outflows to ensure that there is optimal liquidity level that supports the firm's operation. Yeah, so there should be an effective and adequate or optimal combination of the current assets and current liabilities to match with our cash inflows and outflows that we have. You can't spend more than what you have, and the business should always have cash at hand that will help to meet its liquidity position or short-term obligation as and when they fall due. So some of the decisions under working capital management involve cash management and budgeting, inventory management, which level of inventory that the organization want to maintain. Is it at the maximum, at the minimum, at the reorder level? All these are working capital management decision. Account receivable management. How many days does it take for we to pay or for we to receive money from our debtors? How many days are we setting that maybe in the year the maximum receivable days should be 30 days? And if it exceeds, what's the decision? We also make decision about account payable management or the trade payables management. The number of days it will take us for us to pay our creditors. These are all working capital management or short-term planning decisions. So why profit maximizing may not be the ultimate objective of a firm. So maximization of profit may not be the optive or the ultimate objective of an organization. Every business gears towards profit maximization or gears towards making profit. But profit, as it says here, profit maximization is ambiguous because the time horizon of profitability is not clear. If you say profitability, are we talking about 6 months time? Are we talking about 6 years to come? So if profitability or profit maximization is the time frame is 1 year, businesses may do what we call window dressing just to achieve a higher profit, which might not sustain in the long term, right? So let me read from here the point 2. Accountants estimate profit based on the accrual concept. Do you get it? So these are some of the factors or the policy that influence the profit maximization of an organization. Accountants estimate profit based on the accrual concept, and the accrual concept talks about income or revenues are recorded when they are realized, but not when cash or its equivalent is received. And expenses are also incurred. They are incurred when they are made and not when cash or its equivalent has been paid. So it means that the sales or the revenue figure will include cash sales and credit sales. You get it? Yeah. So all these are factors that will influence the profit figure at the end of the calculation. Also, in calculating profit, depreciation, which is a non-cash flow item, is deducted from the net revenue, which intends to understate cash flow. Alright, so depreciation is also another policy that accountants use. Alright, so and whether they use the straight line method or the reducing balance method, at the end it will understate the revenue figure. So profit maximization may not be the ultimate objective of a firm because the time horizon of profitability is ambiguous. It's not clearly defined whether it means profitability in the short term or the long term. All right. So finally, capital expenditure, which is an outflow of cash, are not included in the estimation of profit, and that overstate cash flow for the period. So by not incorporating the above dynamics, the profit level is deficient in determining a measure for the best interest of shareholders. So we can base on profitability or profit maximization to conclude that yes, a business is performing. Yes, yeah, because if profitability is defined in the short term, managers can hold customers with the firm's product so that they can record huge figures for revenue, and after the short period of time they will let the customers return them just to record higher figure of profitability. I hope you understand. Yeah, so profit maximizing wouldn't be the best objective or ultimate objective of a firm. What is then the goal of financial management? So the ultimate goal of financial management is to maximize the wealth of shareholders. Yes. And this is defined as increasing the share price of a company continuously. This goal is clear. You get it? So the goal is sufficient, clear, and devoid of all the problems associated with profit maximization. So increasing the share price of a company continuously should be the ultimate goal of the financial management and not profit maximization. I hope you understand. So the ultimate goal of financial management is to increase the share price of a company continuously and not profit maximization. It is important that financial managers direct all their decisions to promote the best interests of shareholders who has a residual interest in the affairs of the company. Shareholders are the last to receive the residual interest in the company after debtors has been paid, after preference shareholders have been paid, after some expenses that has been incurred has been deducted. So they just receive the residual interest. So the ultimate goal of a financial management is to try to increase the share price of the company continuously and not the profit maximization. All right, so yes, we've come to the end of this section and we looked at the following key things. Some firms are for profit, others are not for profit. However, profit cannot be easily delineated. Profitability can also ignore risk. When managers decide to engage in non-core risky activities, that will promote short-term gains at the detriment of the interest of the shareholders in the long run. Yeah, which shouldn't be so. You get it? So today we've learned that the ultimate goal of financial management is to increase the share price of the firm or of shareholders continuously and not profit maximization. Third point says that we support the argument that the main goal of financial management activity is to maximize the wealth of its shareholders, which is translated as increasing the share price continuously. So this proposition is sound. Listen to it carefully. This proposition is sound because it satisfies the last babies of firms, stakeholders, shareholders. So for every family, if your last baby is satisfied, it means all other babies are already satisfied. Yes, of course, last babies are more like the residual holders of the surplus or of the remaining items. So if your last baby is satisfied, then it means that other babies are already satisfied. It simply means that the ultimate goal of financial management is to maximize the share price of its firm. Thank you. And these are some of the questions for your consumption. You can go through and try your hands on it as you learn this section. Thank you, and I'll see you in the next section. Bye bye.